I want to spend a minute to talk about asset allocation versus asset location because this involves the portfolio specifically. And what you can see below here is we have four groups of assets: U.S. stock, foreign stock, bond, and short-term investments, and how a conservative to aggressive growth portfolio may be allocated with those different type of securities or investments. It is starting with the conservative portfolio. You can see there's very little dark blue and light blue, and as you move to the right, it increases because those are the most risky assets in your portfolio long term, but they also can provide the most benefit long term as far as growth. Another point of asset allocation is diversification. Diversification is really important to provide a smooth ride and mitigate any volatility in markets over time. So what you see with this pie chart, basically instead of just having four categories, you could break out stocks into things like large cap, small cap, international, emerging market. You can break bonds into domestic bonds, government bonds, even foreign bonds, and things like real estate. So diversification and asset allocation play a big part in how we build portfolios. Now, we take it one step farther, and that's where we start talking about asset location. So let's talk about how that works. Tax sensitive basically means that there's some ability to control the amount of tax on that security based off of how it's used in a portfolio. Tax sensitive, on the other hand, doesn't matter how you use it, it's going to be taxed exactly the same way regardless of how you use it and any type of strategy you want to try to apply to it. You can see that an IRA and a taxable account under asset allocation would be allocated identical for a client. They're fully asset allocated, but the portfolios would look the same. Now, what we do when we add asset location to it are the two large bars on the right representing an IRA and a taxable account under asset location. Notice that the tax sensitive, the black and the light gray, are moved into the taxable account while the tax insensitive securities are moved into the IRA account. And why do we do that? Because if something's tax insensitive, meaning that it doesn't matter what you do with it or how you treat it or how you strategize with it, it's going to be taxed the same way. How are IRAs taxed? They are taxed completely. It comes in tax deferred, but all the principal and all the growth come out taxed as ordinary income. Very little tax flexibility there. However, on the other assets in the taxable account, that's where we have some ability to bring that net tax return of 1% into play on a portfolio for a taxable account.